So emerging market assets have appreciated dramatically this year across the board. Emerging market debt, emerging market stocks, real estate. Is this the beginning of a bubble? Is this a bubble? Your comment that there are certain inherent attractive features would indicate maybe not, or at least not yet. What does the panel think about where prices are today?
I mean, I think you have to look at it in relative terms. Russia, for example, the equity market was off 80%. Fixed income markets off probably 50%. Most of the activity that you saw in those issues was Russians buying back their debt, corporates buying back their debt, people basically reallocating their shares. What you're seeing now, 100% revaluation, is really, I don't think, a bubble. I think the question is what's next, and that's the next step, which is the money that's coming in from institutional investors who are basically leveraging at LIBOR plus 25 basis points, which is 50 basis points.
Right.
Okay, so that's the issue. Mm-hmm. The issue is whether this hot money coming back into the market will spur another bubble in the next wave. Because what we're hearing in the first quarter of 2010, there's several $1 billion that's going to be coming into dedicated real estate in Europe, dedicated Russia funds, and that's definitely going to push up asset prices another 30%, if you read Goldman Sachs.
I would tend to agree. I think in our market there's been a lot of people asking this question. And I think when we look at how real estate has appreciated in Eastern Africa, a lot of those demographic fundamentals do tend to explain the heat up in prices. And with a slight slowdown, it's very easy to link, what's happening in the West with some of the, just some of the interlinkages we have with diaspora remittances and foreign exchange from tourism, and also our horticultural industry and commodities. So we think that speculation is quite minimal, and it has tended to be borne out. So what we've seen is a slowdown, not in prices, but just in price growth that is moderate. So we think it's quite stable, and it's in the place that it needs to be. But as he says, the question is what happens now, and are we going to see another run-up that might not be so
The other question, though, is who's underwriting the risk? 2 years ago, LIBOR is at 2.5%, 3%. A bank puts 300 basis points, 350 basis points on it and loans the money to Russia. Okay, bank says, I need 300 basis points to cover my risk, 50 basis points for this, and LIBOR is properly valued. Okay, so today the bank needs 800 basis points or 900 basis points. But who's really taking the risk? Not the bank, the government, who's basically underwriting LIBOR at 25 basis points. And this is the problem. Because people are more than happy with the money that they're going to take, but they're it's headed the wrong way.
It's a new shadow banking system funding everything. Okay.
Yeah, but the bubble idea also can be applied at various points in time as too much money shows up for something. Mm-hmm. I believe there was a bubble in Indian land, for example, when too much private equity showed up. There was a bubble in the Brazilian home building market when too much public equity showed up. We don't need 19 publicly traded home builders in Brazil. Nicely, that's taking care of itself. We've bought one, and others will be consolidated as well. There is a bubble that's forming in China because the government wants now to push credit into the real estate industry. Well, the government uses the banks to do so. Now there's land auctions. The government controls all the land. It's a speculative market. It's impossible virtually. We have 2 home builders in China to accumulate land on an economic basis. That's a bubble. When somebody is just showing up at an auction.
How do you define, because there's an interesting question, is the domestic versus the international market in terms of how a bubble is created. Because a lot of times you have a lopsided situation where, as you pointed out, you have private equity coming in from foreign investors who artificially push up prices as locals are just selling into that, right? But then you have another situation where there's a genuine dynamic in the market where you have local investors and foreign investors who are actually trading assets, which can also be the perception of a bubble, but it's a lot more stable than a situation that you described. Because I've seen them both in Russia, and I think it's interesting because before 1998, Russians were doing one thing, was selling, and foreigners were doing one thing, which was buying. And then in 2000, everything switched around, and Russians were buying, and foreigners were selling.
Well,
And
there
that is-
used to be quite a pejorative connotation to emerging markets. It used to be called the third world, right?
Yeah.
And I think it seems that there's a rethink going on among serious investors about how much of their portfolio, how much opportunity they ought to devote to these so-called emerging markets versus the developed markets.
But I think also you have to look at the amount of money that actually circles into these economies, which is domestic money. Okay, recycled through offshore conduits, which is called capital flight in some countries. And in Russia, I would say that pre-98, it was 70% foreign money, 30% domestic money. And I would say today it's the opposite. In the equity markets, it's higher. But in the domestic real estate market and things, and the more substantive real assets, the majority is Russian money coming back from offshore.